Welcome to the Deep Dive. Today, we are cracking open the latest from Acushnet Holdings Corp. You know them as GOLF on the New York Stock Exchange.
Right, the company behind Titleist and FootJoy.
Exactly. We're diving into their Q3 2025 earnings call, which dropped pre-market back on November 5th.
And this one is particularly interesting because the market really liked this report. The stock jumped 4% that day.
It did.
So our job today is to figure out why. Why were investors so convinced by the forward-looking story, especially when, the company technically missed on a key metric?
That's the mission. So let's start with that immediate snapshot, the top line. It was fantastic.
It really was.
Net sales hit $657.7 million. That was a solid 6% increase year over year, or 5.3% in constant currency. It just blew past what the street was expecting.
Yeah, consensus was way down at like $634 million, so a huge beat on sales. But then you look further down the income statement.
And that's where it gets complicated. The diluted earnings per share, or EPS, came in at 81 cents.
Which missed the 85-cent consensus. It was a 4.7% miss, and, EPS was actually down about 9% from last year.
Okay, so that sounds like exactly the kind of thing that would sink a stock. But it didn't. What's the paradox here?
It all comes down to separating the real operational performance from what we'd call gap noise. Acushnet's core business health was actually great.
Yeah, so you're looking at profitability.
Exactly. You look at their adjusted EBITDA. It was extremely strong, hitting almost $119 million.
And for anyone newer to this, EBITDA is just earnings before interest, taxes, depreciation, and amortization. Gives you a much cleaner look at how the business is actually running.
Precisely. And that EBITDA figure was up over 10% year over year. That pushed their EBITDA margin up to about 18%.
So nice expansion there.
A very nice expansion. The whole reason for the EPS miss was almost entirely due to a big non-operational headwind from their tax rate. The market is it's very good at seeing past a tax issue when the core profitability is growing like this.
Right. Revenue strength and margin defense. That's the real story.
That's the story, not the accounting quirks.
Okay, so now that we've established the business is sound, let's drill down. What was the engine that delivered that top-line beat? It has to be Titleist equipment, right? The balls and clubs.
Oh, absolutely. That's the beating heart of the company. It grew 5.7%, and it came from two places that really speak to their premium moat.
Pricing power.
First, pricing power. They got higher average selling prices, ASPs, across every single club category. And second, they saw really strong volume gains in their flagship Pro V1 golf ball franchise.
It's the classic 1-2 punch, selling more units and selling them for more money.
It's the holy grail in consumer goods.
And I saw they specifically called out the new product launches in Q3, the T-Series irons and the SM10 wedges. It seems like launching premium irons and wedges together really helps goose those ASPs.
Of course. That product cadence is critical. When they drop new, highly engineered gear like those T-Series irons, the dedicated golfers, they just rush to upgrade.
And they're willing to pay for it.
They are. And management even gave this incredible little anecdote. They said their quality checks on the Pro V1 result in only about 1 return for every 16 million balls they produce.
Wow. 1 in 16 million.
I mean, that detail alone tells you everything you need to know about why people trust that brand and will pay a premium for it.
Okay, let's look at the other segments. Golf gear bags, gloves, that sort of thing grew the fastest, up over 14%. But FootJoy golf wear, only 4% net sales growth. That feels a little soft.
Well, you'd think so, but that lower growth rate is actually intentional, and this is a really crucial strategic point from the call.
It's on purpose.
It is. Management is deliberately repositioning the FootJoy brand. They are pushing it decidedly upmarket, especially in places like the US, Japan, and Korea.
So they're chasing margin, not just volume.
100%. They are consciously walking away from lower price points. They know it's going to create some near-term revenue pressure, but the trade-off is stronger long-term brand equity and better profitability.
That's some serious discipline, to actively give up sales today to build a stronger brand for tomorrow.
And you see that discipline on the balance sheet, too. They've returned about $230 million to shareholders so far this year through buybacks and dividends.
All while keeping their net leverage ratio really healthy at around 2 times. That's pretty low risk.
It signals durability. And that stability is exactly what got investors so excited when management gave their forward look.
Right. Let's get to that guidance update because this is what really moved the needle. They raised their full-year outlook.
They did.
Full-year revenue guidance is now up to between $2.52 and $2.54 billion. That's up from their old estimate of around $2.5 billion.
And what that raised guidance implies is that they're expecting really strong, high single-digit revenue growth in the fourth quarter.
And just as important, they nudged up the full-year adjusted EBITDA guidance too.
Yep, to the $405 to $415 million range, which just tells the market, hey, this momentum is real and we're confident we can turn it into actual profit.
Okay, but we can't talk about future profits without tackling the big elephant in the room. Tariffs.
The single biggest policy of friction point for them, no question.
Management spent a lot of time on this. It seems absolutely critical for what happens in 2026.
It is. For 2025, the hit is manageable. It's about $30 million in incremental gross tariff cost. But the real problem is what they're calling the 2026 cliff.
That phrase, 2026 cliff, sounds pretty bad. What exactly is it?
It's basically the full annualized and escalated impact of all the tariffs hitting their supply chain at once. So you have new duties phasing in, some temporary exemptions expiring.
And it all adds up.
It all adds up to a total gross tariff impact in 2026 of $70 million.
$70 million. So that's an extra $40 million hit compared to this year. That's a massive guaranteed drag on their cost of goods sold.
Huge. And management says they can mitigate a meaningful portion of that.
But what does meaningful actually mean? How much risk is left on the table for investors?
And that is the billion-dollar question, isn't it? They're relying on three things: shifting sourcing, targeted price hikes.
Which they can do because of that Titleist brand strength.
To a point, yes. And then finally, shifting their product mix toward higher margin stuff. The risk is that if the economy gets worse, that pricing power might not be as strong as they think.
I did notice they're kind of running a little operational hedge. They said they advanced some inventory orders to get ahead of the tariff deadlines.
A very pragmatic move. It just buys them some breathing room.
So let's shift gears to the global health of the golf market. What was the color from management there?
The big picture is very sound. The global golf market is healthy. US rounds played actually accelerated in Q3, and worldwide rounds are on track to meet or even beat the record levels we saw in 2024.
So the macro tailwind is there.
Yeah.
Any specific regions that are doing really well?
Yeah, EMEA, so Europe, the Middle East, and Africa was really robust. Sales up 14% in Q3. Some of that was easy winter comps, but the underlying demand is definitely there.
And the softer spots?
The softer spots were in Asia. Japan and Korea were stable on equipment. People are still buying their Pro V1s and T-Series irons. But management pointed to some weakness in premium apparel and footwear.
So that ties right back into the FootJoy strategy we were talking about.
It does.
If consumers in, say, Korea are getting more cautious about high-end apparel, Acushnet's decision to get out of the lower-priced stuff means they're intentionally focusing only on that most resilient luxury.
You've got it. It's a holistic strategy. The macro environment in Asia just reinforces their internal decision to chase higher quality, lower volume sales for FootJoy. They're leaning into their strengths.
So let's tie it all together. You have a clear revenue beat, strong operating margins, raised guidance, and a management team with a very disciplined plan for a huge future risk. Why did the stock jump so much?
The market chose conviction over caution. Simple as that. Investors saw enough evidence that the demand for premium Titleist products is strong enough to power through any short-term accounting noise and even that big tariff headwind.
They're betting on the compounder story.
It's a bet on the long-term compounder narrative. Acushnet is a business of stable, repeatable growth, and this guidance hike just validated that the cycle is still very strong.
And when you look at the industry, there's stability really stands out. I mean, their competitor, Topgolf Callaway, is reportedly looking to sell its Topgolf unit.
That's a great point. That comparison is key. While Callaway is dealing with this messy portfolio reset, Acushnet is just laser-focused
on high-margin, premium equipment, and apparel.
That operational simplicity is a huge draw. And even though GLFS stock is up nicely this year, it's actually lagged the broader consumer discretionary sector. This report gave the market the confidence that maybe that valuation gap is ready to close.
All right, now we have to pause for our necessary segment.
Because what we are about to discuss is for entertainment and informational purposes only. This is not financial advice.
That's right. We are not advisors. Always do your own research. Take this next part as just an intellectual exercise.
The outrageous but plausible trade idea.
Let's hear it.
I'm good. So given everything we've talked about, the resilience, the low leverage, the pricing power, we can pitch an option-enhanced paired trade.
Okay, let's break that down and make it simple. What's the goal of this trade?
The goal is to aggressively bet on GLF's steady long-term growth. The core idea is this. You go long GLF shares, and you finance it by selling out-of-the-money cash-secured puts.
Let's unpack that jargon. Selling out-of-the-money cash-secured puts. What are you actually doing there?
In simple terms, you are selling someone else the right to sell you the stock at a set lower price in the future. In exchange for selling them that right, you collect cash a premium today.
And out of the money just means that price is way below where the stock is trading now.
Exactly. So you only have to buy the stock if it drops quite a bit. You're basically getting paid today to agree to buy the stock at a discount later.
And that cash you get today helps pay for the shares you're buying.
It effectively lowers your cost basis. You benefit from the growth, the buybacks, and the outrageous part is the high conviction bet that their product quality moat. Remember that 1 in 16 million stat is strong enough to insulate them from that $70 million tariff hit better than anyone else.
It's a bet on Titleist versus global policy risk.
That's the core thesis.
And that brings us to the end of this deep dive. The takeaways are clear. The market is valuing revenue momentum and raised guidance, looking right past a temporary EPS miss.
And management has a clear, disciplined plan to reposition FootJoy and tackle that huge tariff hurdle coming in 2026.
Which leads us to our final provocative thought for you.
Right. Golf participation is structurally sound. The U.S. saw a record 545 million rounds played in 2024.
A huge number.
And Acushnet is constantly expanding its custom fitting network. So the question is, how quickly can they turn that macro tailwind of participation into sustained premium price growth by pulling all those newer golfers deeper into the expensive Titleist ecosystem?
That is the challenge for 2026 and beyond. Thank you for joining us. And remember, we are not financial advisors. This discussion was purely hypothetical and for educational purposes.
Always do your own research. Until next time.